Hello and welcome to Livewire's 2024 income series, dedicated to helping investors make the most of the Goldilocks era for income. I'm Ali Selby, and today we'll be learning how investors can use quality global large caps to generate consistent yield. And to do that, we're joined by the Co-Chief Investment Officer of Talaria Asset Management, Chad Padowitz. Thank you so much for joining us today, Chad. Really excited to feature you in our income series.
Great, thank you. Good to be here.
We've obviously seen momentum and cyclicals really dominate the market over the past year, particularly in global equities. How has the team navigated that environment?
We're a bottom-up investor, so we go where the value is. And as of now, we don't see much value in the US. We see that it's quite an expensive market. We're seeing a lot more opportunities in other regions like Europe and Japan. Sector-wise, we see healthcare as a particularly interesting environment. Given that we believe the economic scenario is getting weaker, we like less economically sensitive companies, companies with better balance sheets, and that are basically somewhat out of favor because they're not part of the market narrative of growth and cyclicality. So we definitely see more value in those sort of sectors.
I know you said just now that you're a bottom-up investor, but I feel like you have to take notice of what's happening on the macro. Feels like every month the narrative is changing on the rate outlook. What's your expectations for rates over the next 12 months, and has that shaped your portfolio at all?
We're not economists, we don't forecast interest rates and so on. We do think that the economic cycle is driven by interest rates, and they have obviously risen quite substantially, as we know. So we certainly believe that economic conditions are getting tougher going forward, and that will have an impact on company profitability, earnings and valuation. So what we have done is we've removed ourselves from a lot of that risk within the portfolio to focus on companies less impacted without specifically trying to forecast what rates will or won't be in any certain time frame.
Let's get a little bit more granular now. I know that Talaria has quite a unique investment process using put options. Without any jargon, is it possible you could take us through that?
We do the bottom-up work and we want to buy a company. But what we then do is instead of buying it directly, we sell a put option on the share we want to own, which is really a promise to buy at a certain price. So as an example, let's assume a company's trading at $100 and we think it's worth $120. Rather than buying it directly, we sell a put option, which trades on the stock exchange, and we would sell it 2 months out for a strike price of, say, $96. So we're agreeing to buy it at 96, it's trading at 100, we think it's worth 120. But in return for that obligation to buy this share, we're going to charge a premium. So in this example, we'll charge $3. So we're getting paid about 3% for 2 months, so it annualizes at around 18%. So a very high return. Now, two things are going to happen. If in 2 months' time the share is below 96, we will get ownership of it, but our net cost will be 93. So we take a lot of risk away. If it's above 96, well, we won't get it, but we might redo it. But either way, we keep that $3. Importantly, there's no leverage, so we 100% cash back it. It's in the local currency of the option, and it's exchange traded.
Put options are obviously the playing field of short sellers usually. How does this differ from what they would do?
What we use options is purely as an implementation on a bottom-up long-only portfolio. We sell it on shares we want to own. There's no leverage. It's not speculation. It's merely to get paid for the taking of the risk with a buffer and to get that share we want to own in a better way.
Is there any evidence that supports using that put option strategy over, I guess, just investing long in stocks?
Yeah, well, there's probably 2 data points I would highlight. One is there's an implied volatility versus realized volatility. And what I mean by that is implied is what the market thinks the volatility will be, and that's the price, like insurance, you can charge. And as we know from human behavior, people overpay for insurance because you want to take away that uncertainty. You're prepared to pay for that. So when one looks at historically implied how much people are prepared to pay versus what actually happens, the realized volatility, there's a very sustainable, very big gap between that. And we're able to, as a seller of insurance, take advantage of that. Second data point I'll use is we've been running the strategy, for nearly coming on 19 years. And just, for instance, over the last 10 years, for instance, we've generated north of 7% a year in option premium. So we've actually, it's the actual delivery of that.
Is there an example of a stock where you've used that strategy. Can you take us through an example so it feels more tactile and real?
Sure. So just more recently, there's a company, a German chemical distribution company called Brenntag. So that share's trading at it's at 70 euros, and we think it's worth over 90 euros. So we think it's very attractively priced for a range of bottom-up reasons. But what we do is, instead of buying it directly, what we do is we sold a 68 euro put option. So we agreed to buy it at 68. It was trading at 70, and we got €2 for that. So we got paid €2 to agree to buy something at 68. It's trading at 70. So you can see, if we do end up owning it, our net cost will be 66. And if we don't, we still got that too, which obviously is adds up to a significant annualized return, because we're doing it for about 2 months, and we think it's worth about over 90. So that's sort of how that all comes together.
Where else are you seeing the most opportunity today within it? Which regions or sectors? Where are you seeing the most exciting opportunities on the global stage?
Yeah, so certainly the US, we find, is the most expensive place, and we're seeing a lot less opportunities than historically has been the case. We see more opportunity in places like Europe, where we're able to buy companies like Roche, a pharmaceutical company, or France, where we're buying a catering company called Sodexo, or Japan, where we're able to buy a security company called Seacom. So, basically outside of the US, outside of tech, is where we're seeing disproportionately more and more opportunities relatively.
Last year when we spoke, you were holding 20% cash. You're still holding 20% cash. Why is that? And are you looking to put that cash to work?
We go where, as I mentioned, the bottom-up opportunities are, and when valuations and individual stocks become more attractive, we will absolutely deploy that. We are sitting in an environment now where markets are hitting all-time highs, volatility is very low, there's not much concern about risks, which we think is imprudent, so we will absolutely deploy that as and when. Just to bear in mind, in the fund's history, we've been as low as 2%. So we absolutely will deploy that when it makes sense to do so.
Do you foresee some sort of pullback on the horizon then, where you could deploy that capital?
It's too hard to forecast short term and medium term. We do think that the valuations are very high, and we believe the volatility is low and the risks to earnings are underappreciated. So there certainly is an increasing environment where you could have a significant pullback in equities, without actually saying we think it's going to happen, how it's going to happen, but we certainly see the risk to current equity prices as being relatively high, certainly at the index level as we speak.
The motto for this series is the Goldilocks era for income. It's obviously been easier than it's been in about a decade for investors to generate income on their investments. How can investors make the most of the income opportunity in your asset class over the next 12 months?
Yeah, well, I think important on income to take into account inflation. Now, with inflation having risen from very low levels to well over 3% in most economies, even if interest rates have risen to, say, 4.5%, the real returns are actually quite low still. So you do need places to earn higher than that, more sustainable amounts. In our fund, we have actually multiple sources of return. We are a global equity, long-only, bottom-up fund, so we are looking to make money from the shares we buy. It's merely our implementation which does generate income, and it does generate it at north of 7% a year consistently, not dependent on dividends, not dependent on interest rates, less dependent on economic conditions. So it's that combination of capital gains, high levels of differentiated income, that we think puts you in a very good position in this current environment.
Given that volatility is quite low at the moment, how can you generate that income right now?
Yeah, look, we always benefit from more volatility. So we would, we get a better buffer in terms of shares we want to buy, we get better option premium. So we do want more volatility, but the funds historically generated around 6% on the low end and over 11% on the upper end in option premium. So a lower volatile environment like we're seeing now, we would just be at the lower end of that range, which is still a very high number. It's also importantly still maintaining a very big gap between the realized volatility, as I mentioned earlier. So we're still exploiting that volatility risk premium.
Okay, well, thank you so much for your time today, Chad. It was awesome to feature you in our income series.
No, you're welcome, thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.